Welcome to our deep dive on choosing a 529 college savings plan. Today we will cut through hype and focus on what actually compounds for your family's future: costs and consistency. To begin, we'll set aside the allure of analyst star ratings and concentrate on low fees, broad market index funds, and the practical decision of whether to switch plans at all. Next, we'll outline exactly how to evaluate your own plan with confidence. If your home state does not offer a state income tax deduction or credit for 529 contributions, you're free to shop nationally. That flexibility is powerful because it lets you focus on expense ratios and underlying fund quality, rather than being locked into a single state's plan. Ratings can be informative, but they fluctuate and rarely indicate a catastrophic failure. Instead, long-term results typically depend on the underlying investments and the costs you pay. Therefore, prioritizing low fees and broad index exposure is the most reliable path. Now, let's review our roadmap. Here is the plan for today. First, we'll clarify how state rules affect your plan selection. Next, we'll compare ratings with real, persistent costs. Then, we'll share concrete fee targets. After that, we'll explain which index funds to seek out. We will also discuss when switching plans is worthwhile and when it's not. Finally, we'll walk through a decision flowchart and test your understanding with a quick quiz. Let's start with the key state rules. This presentation is for educational purposes only and does not constitute financial, tax, or legal advice. Investment decisions involve risk, and you should consult a qualified professional who understands your circumstances. With that said, let's move into how state rules affect your choices. If your state provides no tax break for 529 contributions, you are free to choose from any plan nationwide. That means you can place fees and fund quality at the top of your criteria. This flexibility is a significant advantage because it allows you to seek the lowest expense ratios and the most reliable, broad index options. Ratings, on the other hand, should be treated as informational. They can change for minor reasons and rarely represent dramatic shifts in long-term viability. Always confirm the expense ratio and any program fees within the plan disclosure, as these directly affect your compounded returns. Next, let's weigh ratings against fees. On the left, we have ratings. These are opinions that fluctuate, sometimes in response to administrative or fee structure changes that do not materially alter long-term outcomes. Ratings can create a sense of urgency that is not warranted. On the right, we have fees. Fees are persistent, subtract directly from your returns, and compound negatively over time. Unlike ratings, you can actively choose lower fees. When forced to choose, costs should dominate because they are predictable and controllable. With that comparison made, let's set specific fee targets. Concrete targets help you act decisively. Look for plans with expense ratios well below 0.10%, and understand that some of the best options are near 0.06%. Favor passive, broad market index funds that track the Total U.S. stock market or the S&P 500. These options provide diversified exposure at minimal cost. Avoid high-fee active management unless you deliberately choose to take on higher costs and tracking risk. Remember that every basis point saved today compounds over time. A simple checklist can keep you on track. Expense ratio under 0.10%, passive index options, clear disclosures, and low program fees. Next, let's map the decision visually. This flowchart begins by asking whether you receive a state tax deduction or credit for 529 contributions. If you do, it suggests preferring your in-state plan while explicitly calculating the after-tax benefit. Then it asks whether your in-state plan's fees are competitive. If they are not, you should weigh the tax benefit against the higher fees to determine a break-even point. If the fees are competitive, proceed to open the account and automate contributions. If you do not receive a tax break, the chart directs you to shop nationally for the lowest possible fees. It then tests for an expense ratio below 0.10% and the presence of passive total market or S&P 500 index options. If either condition is not met, you loop back to searching. If both are satisfied, you open the account and automate contributions. Now that the decision path is clear, let's talk about what to invest in once you are inside a plan. Once inside a plan, simplicity wins. Choose a Total U.S. stock market index or an S&P 500 index for broad exposure and minimal cost. If you prefer a set-it-and-forget-it approach, consider an age-based portfolio, which automatically shifts toward bonds and cash as college approaches. If you manage allocations manually, you can add a low-cost bond index separately. Whenever possible, use automatic rebalancing features to maintain your target allocation without constant oversight. Next, let's visualize how fees erode returns over time. This pie chart is illustrative and compares a low-fee scenario to a higher-fee scenario over 20 years. The larger slice represents returns kept, while the smaller slice represents returns lost to fees. The exact numbers will vary with market returns and contributions, but the principle holds. Higher fees cause compounding drag. Therefore, minimizing fees preserves more of your returns for tuition. Now, let's turn this into an actionable process you can follow today. Follow these steps to select a plan effectively. First, confirm whether your state offers a deduction or credit. Second, if there is no tax benefit, begin a nationwide search. Third, filter plans for expense ratios under 0.10% and verify the availability of passive total market or S&P 500 index options. Fourth, read the plan's disclosure for all-in costs, including any program fees. Fifth, choose between an age-based or static allocation that fits your comfort with risk and maintenance. Sixth, automate contributions and set reminders to stay consistent. Seventh, review the plan annually, focusing on fees and underlying investments rather than rating headlines. With the process in hand, let's ground this with an illustrative table. This table is for illustration only and does not represent recommendations. It shows how expense ratios and index types vary. Plans with expense ratios near 0.06% are highly competitive. S&P 500 index options around 0.08% can also be attractive. Active options are typically higher cost, which reduces net returns unless the manager outperforms after fees. Some programs include separate administrative fees that raise the all-in cost, so always check disclosures. Now, let's confirm your understanding with a brief quiz. Question: if your state offers no tax deduction for 529 contributions, what should be your top priority when choosing a plan? Options: A, the plan with the highest analyst rating. B, the plan with the lowest fees and solid passive index options. C, the plan from the most popular brokerage. D, the plan recommended by a friend. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, the plan with the lowest fees and solid passive index options. Costs are persistent and entirely within your control, and broad index exposure provides durable diversification. Now let's try one more question about ratings. Question: a 529 plan you own is downgraded by an analyst. What is the most reasonable first response? Options: A, immediately roll over to a new plan. B, do nothing and ignore all news forever. C, read the disclosure to see if fees or underlying investments materially changed. D, stop contributing to 529s entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Most downgrades reflect minor administrative changes, not fundamental shifts in investment quality. Always verify whether fees or underlying investments changed in a way that would impact long-term results before making a move. Next, let's lock in the most important takeaways. Here are the key points. If you receive no state tax benefit, you can select from any plan nationwide, which allows you to prioritize ultra-low fees. Ratings are opinions that fluctuate, while fees are persistent and compound against you. Aim for expense ratios under 0.10%, with some of the best options around 0.06%. Prefer passive broad market index funds like Total U.S. or S&P 500. Avoid unnecessary switching if your existing plan already meets these criteria, especially for small balances. Automate contributions and watch for fee creep during annual reviews. To wrap up, let's summarize the entire message. In summary, prioritize costs and index quality over analyst ratings. If your current plan already offers low fees and broad index exposure, the friction of switching often outweighs potential benefits, especially for smaller balances. Consistency and low costs are the two engines that power long-term success. Finally, let's close with a thank you and a quick nudge to support the channel. Thank you for watching. If this video helped you clarify your 529 plan strategy, please like the video, share it with someone who needs it, and subscribe for more clear, no-hype content. Post your questions and your state in the comments so we can discuss specific scenarios together. See you in the next video.